You are listening to Seven Horns AI, your AI-powered market briefing. Happy Monday, July 13th, 2026. Today, we are looking at the S&P 500 through the lens of the SPY ETF, and we have a fascinating tale of two models pointing toward what looks like a classic buy-the-dip scenario. If you look at the market over the last 2 weeks, tech stocks have been wobbly and futures are red this morning. But if you step back and look at the last month, the picture changes. We see money quietly rotating out of overbought areas and into banks, materials, and commodities. Now, moving on to what our AI models are actually seeing. We run two different versions of our prediction model on the SPY, both forecasting where the market is likely to be 5 trading days from now. The short memory model, which looks back at about 2 weeks of history, is focused on this recent choppiness and tech weakness. It is predicting a downward move with a 51.3% probability. Speaking of which, the long memory model looks at a broader 1-month window and sees the underlying rotation. It is predicting an upward move with a 58.1% probability. This is not a contradiction, but rather a sequence. The short memory model expects a dip, and the long memory model expects that dip to get bought. Another interesting development is our daily pattern clustering study across our top 50 most tracked stocks. Today, that study fired at +1 standard deviation up, which is a moderately bullish cluster. When this signal has appeared in the past, across 286 historical instances, the S&P 500 was higher 5 days later, 69% of the time, with an average gain of nearly 1%. So, how might this sequence play out? Early in the week, we could see the short-term dip materialize as soft futures and upcoming inflation reports on Tuesday and Wednesday bring near-term volatility. But by the middle of the week, the long-term rally could kick in as big bank earnings report and commodity prices rise, drawing money back into the market. Of course, we must note one caveat. The broader 232 ticker study remains neutral, meaning this bullish signal is concentrated rather than a rising tide lifting all boats. Geopolitical risks, particularly the recent Iran headlines, also remain wildcards that price pattern models cannot fully predict. But on balance, the weight of the evidence suggests that if you have been waiting for a pullback to put money to work, this week may offer exactly that window. That is your market update for today. This has been a Seven Horns AI production. For more insights, visit us at sevenhorns.ai.